Okay, so for the last 2 weeks of term, I want to do basically a mini stock market game in class. We'll see how it goes. It may or may not work, but we'll give it a crack for the first few days. But in order to do that, you have to actually understand what the stock market is. So in Australia, we call it the ASX, the Australian Stock Exchange, funnily enough. Basically, as you can see here, there's a bunch of companies and then basically people buy and sell them. Now, how did this all start? Well, in a capitalist society, companies need to get money, right? So if they want to grow, so let's take a shoe shop, for example. Let's say somebody starts making shoes and then they want to get bigger, which means they need to buy a bigger place in which to make shoes and employ some people and get some bigger machinery and things like that. But they don't have enough money to do that. So what they do is they go to their mate and they say, look, if you invest in my company, I will give you 10 shares in my company. And then every year you will get X percent of profit. So let's say it's 10% of my company, you will get 10% of the profit. And so every year when the company makes profit, that person who invested that money will get 10% of the profit. So they own a 10% share in that company. What happened was that this is how it all began, and then it got more and more complicated. So you ended up with what was called a stock exchange, where what's actually exchanged is stock. And this is actually shares in the company. So instead of it being 10%, it will be 500 shares or whatever, and the company will be divided up into a certain amount of shares, and then each share would get what is called each year a dividend. And what that means is it will get however much profit the company make, it will get divided among the shareholders at a certain rate, depending on how many shares there are. So for example, your dividend might be a whole $1.25 if the company made not much money. So you can see here, you're down into 0.022. These are cents. So, it's not making much money, all right? If they are cents, they may also be dollars. So this might be $2.43, which means this is 22 cents. So we're down into, and this is not even 3 cents. So we're down into really not a lot of money, right? For some companies. Of course, other companies will turn much larger dividends. When it's in green, it means it's making money, and when it's in red, it means it's losing money. So of course, what this means is that if you put money into a company and the company loses money, then you get no returns at all. You get no dividends. So for that year, you get nothing back. You don't have to pay more money or anything, but you don't get anything back. In the stock market crash of 1929 to 33, companies lost so much value that people lost all the money that they had. Because remember the difference between wealth and income. So people could say, I'm quite wealthy because I have this many dollars in shares, but because it's not what we call a realized asset. Realized means it's actually not cash. It's actually an asset that's sitting there and you can point at it and say that's worth money. Like a house, you can point at your house and say, hey, I've got a $500,000 house. So the bank will say, yeah, okay, you're worth $500,000. But then if your house drops in price and it's not worth $500,000 or more anymore, then you're not worth that much money. So the stock market crash, when it happened, was so bad that companies went into negative value, which means obviously they're folding. And that means that people lost all the money, which is why it was such a devastating time and people were really devastated by it. And the same sort of thing happened in the global financial crisis. All the banks lost their stock value, and that's one of the reasons why it was so bad. And they lost their stock value because literally they lost their value. And I'm happy to talk about that a bit more. So that's what a stock market is. A stock market is basically a place where people can go to ask for money from other people. And those people then can become what are called shareholders. Once you become a shareholder, you're entitled to go to the shareholder meetings and tell the company how it's supposed to be run. Any shareholder can attend a shareholders meeting and stand up and tell the executives how the company should be run. This used to be a really, really good tool in the days where you had a few hundred shareholders. But of course, in companies like Apple and Microsoft and that's what, you got a couple of million shareholders. So, it gets a little out of control. The other thing is that you can buy shares in a company to take it over. As soon as you own 51% shares, you own most of the company. And that's what we call takeovers. And you may have heard of that. And that's how some companies get taken over. All right. So the stock market is basically a place where you buy and sell bits of companies that then will make you money or not. You can pause this and have a read if you like. This is just, I'll give you this website for class. So the Australian Stock Exchange does a bit of education and stuff about what is in a stock market. I'm going to run you through these a little bit. So capital growth means that that's a company that you invest in on the expectation it will grow over time. So that's like investing in a house. You don't buy a house this week. You know, these flipping shows where people buy a house one week, do some renovations and then flip it and make some money. That's quite rare. Most people will buy a house on the expectation that they will sell it in about 10 years' time and make some money. Dividends, I've already spoken about. That is where you'll get your shares and your profit. So you can do that. And buying and selling, obviously that's how people buy and sell. And the stock market makes its money by taking a bit of a fee on that. All right, now spreading your risk. This is one of the reasons why I was talking about risk. I'm going to talk about different types of shares in a minute. But you can take high risk shares and low risk shares, and what you do is we call this a portfolio. And what you normally want a diverse portfolio, so you spread your risk. And as a shareholder rights, as I spoke about this, as a shareholder, you get to go to the company and tell them how to run their money, run their company. All right. So I'm going to give you that on the classroom, so don't worry about too much about that. But it's just a bit of information for you. All right, so there are different types of shares that you can invest in. Blue chip shares are called blue chip because they're safe. What that means is that they won't be, they're growth shares particularly, and I've got growth stocks down there as well, but blue chip don't necessarily have to be growth stocks, and growth stock don't necessarily have to be blue chip. But blue chip are good, stable companies. Things like Coles, they've been around for a really long time, BH Billiton, there's a range of really good, strong companies that have been around a really long time. They don't take risks. They're not in a high risk field, and so that's why they're called blue chip. Other ones are startup companies. They're high risk, but normally high return. Startup companies are often in the medical field or in the technological field, and they're brand spanking new, and you invest in them. Now, in order to get to the stock market, you can't be a true startup. You actually have to have been doing a bit of business beforehand. If you want to invest in a true startup, you have to be what's called a venture capitalist. I'm happy to tell you about that if you're interested. But there are a lot of startups that make it to the stock exchange. They do their release, and then and then their shares either go up or down. Sorry. Growth stocks are growth, as I said, stocks that you invest in. Now, for our class activity, I don't recommend growth stocks because you're going to try and turn a profit in 2 weeks, which means what you're looking after is yield stocks. They're stocks that give you dividends, but they're stocks that are going to give you a high yield. So they're profits, they're ones that are growing quite aggressively and that are making a bit of money. So that's what you're after. Because this is what we're going to do. I'm going to give you a mythical $10,000. I don't have the $10,000 for all of you because that'd be heaps of money and I just don't have that. Sorry. So you're going to get this mythical $10,000. You're going to choose a portfolio. You're going to put it into a Google Sheet. All that's going to happen in class 1. Then you're going to track the share price over the 2 weeks. And you're going to see who makes the most money over the 2 weeks. And whoever makes the most money will get a prize, is basically how I'm going to do this. So you've got to choose your portfolio well. We'll talk about it in class, but the idea is that you will learn how to use the stock market. You will learn how to watch the share prices. You'll learn how to do a bit of research into companies. I'm also going to teach you to read financial statements and things like that. I know this might not sound very exciting to some of you, but it's actually important to do in order to understand what companies are doing around you. While you're only in year 8, I think this is a good time for you to learn that big companies have a lot of reporting that they have to do. And it's another part of being a savvy person in the world in which you live, so that you know that when you hear on the news, such and such company did X, well, you might be able to then go, oh, I wonder why that is. And then you can go to X's company's financial statements and go, oh, now I understand why company X did that. And it's a way of banking you, helping you understand the world in which you live and understand what's going on, because as we did in the recession week, the stock market plays a big role in our economy, and it is the one that can lead to recessions and depressions. So it's worthwhile knowing something about it.